Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Markets are already pricing in Fed rate cuts for later this year, even though the committee is holding the policy rate steady at 3.50 to 3.75%. If you're trading equities, bonds, or crypto, you need to understand what's baked in and where the real opportunities are sitting. Let's break down the signals, the data, and the positioning plays that matter right now. The June 16 to 17, 2026 FOMC minutes tell a critical story. According to the official Federal Reserve documentation, the committee voted unanimously to hold rates. But under the surface, two members, including Stephen Moran and Christopher Waller, actually favored a quarter-point cut. That dissent is notable. It signals growing internal pressure for easing, even while the headline decision remains hawkish. The new Fed Chair, Kevin Warsh, has launched 5 policy review task forces focused on improving communication and decision-making frameworks. Market participants are reading this as a potential setup for a more dovish pivot if incoming data continues to support it. So what does the market think happens next? Fed funds futures are currently pricing the effective Fed funds rate target at approximately 4% by year-end. That's not a cut priced in yet. It's uncertainty. Traders are hedging both directions, but the key phrase from the FOMC is that future rate decisions will be based on incoming economic data. That means every inflation print, every employment report, every geopolitical shock matters for repricing risk across asset classes. Let's talk inflation first. According to analysis from Inflection covering the August CPI report, core inflation readings are moderating from their earlier elevated levels. The Fed's 2% target is still not in sight, but the trajectory is improving. Slowing inflation is the prerequisite for any future Fed ease, and the data is trending in that direction. Energy price swings and geopolitical developments continue to complicate the picture, but the baseline case is disinflation continuing through the back half of 2026. Employment is the other side of the dual mandate, and it remains robust. Unemployment is hovering around 4.2%. Job additions are steady, initial jobless claims are low, and the labor market is near full employment. This is why the Fed hasn't moved yet. But here's the inflection point. If inflation continues to moderate while employment softens even slightly, that combination unlocks the door for rate cuts. The FOMC is balancing these two forces in real time, and the next few data releases will be critical. Now let's get into what's priced across asset classes and where the opportunities are. Equities are already reflecting rate cut expectations, particularly in growth-sensitive sectors. Technology and consumer discretionary stocks are getting a boost because lower rates reduce the discount rate on future earnings. According to iShares research on Fed outlook and fixed income strategies, rate cuts are viewed as a catalyst for a rally in these sectors. If you're positioning for a dovish pivot, growth stocks offer leverage to that thesis. The valuation compression we saw during the rate hike cycle reverses when funding costs decline. Watch for sector rotation into names that benefit from lower capital costs and higher multiples. Bonds are repricing aggressively. Treasury yields, especially in intermediate maturities, are adjusting to the possibility of a lower yield environment once the Fed eases. According to Morgan Stanley's analysis on the Fed rate pause and fixed income market impact, there's an emerging opportunity in building bond ladders and shifting duration exposure to intermediate maturities. If the Fed cuts later this year, yields will drop and prices will rise. Positioning ahead of that move is the play. For fixed income traders, this is a tactical window to lock in yields before the policy shift. Crypto is where things get volatile. According to FEMEX's analysis on crypto derivatives and macro trends, open interest in crypto futures is surging and funding rates are climbing. Traders are rebuilding leveraged positions in anticipation of a cheaper money environment. Lower risk-free rates on government securities make the risk-return profile of crypto more attractive on a relative basis. But here's the key dynamic. Sell the news behavior. When the Fed actually announces a cut, leveraged positions often unwind violently as traders take profit. If you're playing crypto into a Fed pivot, manage your leverage discipline. The opportunity is real, but so is the whipsaw risk. Let's zoom out and connect the dots across asset classes. What we're seeing is a repricing event happening in real time. Growth stocks are rallying on lower discount rate expectations. Bonds are rallying on lower yield expectations. Crypto is rallying on lower funding cost expectations. But all of this is conditional on the data cooperating. If inflation reaccelerates or employment stays too hot, the Fed won't cut, and all of these positions unwind. That's the risk. Here's the specific positioning intel. For equities, tilt toward technology, consumer discretionary, and other growth sectors that benefit from lower rates. Names with high future earnings multiples get the biggest boost. For bonds, intermediate duration treasuries offer the best risk-reward as you position for a yield curve shift. For crypto, tactical plays and derivatives are available, but keep leverage in check and plan for volatility around actual Fed announcements. Sector rotation is another angle. In an environment where inflation and employment data can sway Fed policy meeting by meeting, you want strategies that hedge relative shifts in monetary conditions. Defensive sectors like utilities and consumer staples underperform in a dovish pivot, while cyclicals and growth outperform. Position accordingly. Let's talk numbers. The current Fed target is 3.50 to 3.75%. Fed funds futures price the year-end rate at approximately 4%. Unemployment is at 4.2%. At least 2 FOMC members favored a quarter-point cut at the last meeting. Kevin Warsh has initiated 5 task forces to review policy communications. These are the hard data points driving market positioning. The takeaway is this: even with robust employment, the combination of moderating inflation and evolving Fed communications under new leadership is already being priced into risk assets. Whether it's a strategic tilt toward growth stocks, reconstructed bond ladders, or tactical plays in crypto derivatives, every asset class is reflecting the possibility of Fed rate cuts, but the market is also pricing in the uncertainty. The next FOMC window and the economic data leading into it will be critical for fine-tuning these expectations. According to the Conference Board's analysis on the June FOMC decision, every new economic data release in the coming weeks will be pivotal. Inflation prints, employment reports, and any geopolitical developments that move energy prices will all feed into the Fed's decision tree. Traders need to stay nimble and adjust positioning as the data evolves. One more layer: the leadership change at the Fed matters. Kevin Warsh's 5 task forces signal a potential shift in how the Fed communicates and operates. Market participants are watching closely to see if this translates into a more transparent, more dovish communication style that greases the skids for rate cuts. According to Forbes Advisor's Fed funds rate history analysis, leadership transitions at the Fed often precede policy inflection points. This could be one of those moments. Bottom line, the opportunity is in positioning ahead of a late 2026 rate cut, but the risk is in getting the timing wrong. If you're trading equities, focus on growth sectors with high sensitivity to discount rates. If you're in bonds, shift to intermediate duration and lock in yields before the curve moves. If you're in crypto, play the leverage game carefully and plan for volatility. And across all asset classes, watch the data. Inflation and employment are the twin pillars that will determine whether the Fed cuts or holds. The market is telling you a story right now. Fed funds futures, treasury yields, equity sector performance, and crypto derivatives open interest are all pointing in the same direction. Lower rates are coming, but the timing depends on the data. Position accordingly, manage your risk, and stay agile as the narrative evolves. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.